This wasn't a bad week. This was the week the silver market officially died. The paper price says that silver closed Friday at $67 to $76 per ounce, depending on which exchange you're looking at. The fact that there are 5 different closing prints tells you everything you need to know. The market is broken, but here's what really matters. While the paper price crashed to the low $60s, while futures traders were getting liquidated, while margin calls were flooding in, try to buy physical silver. Go to APMEX right now. They're charging $96.08 per ounce for a silver eagle. That's a 23% premium over a $77.95 spot price. Go to JM Bullion. They're charging $100.56 per ounce. That's a 29% premium. You're paying over $100 for an ounce of silver while the paper market prints in the low $70s. The spread is 30%. The market is broken. And it's not just premiums. SD Bullion just reported that new sovereign mint orders are running 8 to 10 weeks out. That's up from 2 to 3 weeks just 30 days ago. The Perth Mint temporarily shut down new sales on key bullion lines to catch up on existing obligations. The US Mint delayed the 2026 proof silver eagles by 1 month. When they finally released the 2026 eagles, they sold out instantly. This is not a functioning market. This is a crime scene, and I have the forensic evidence that proves it. By the end of this video, I will show you the exact numbers that prove the vaults are empty. I will show you why the paper price crashed while physical demand exploded. I will show you why the Shanghai premium hit 29% while COMEX printed in the $70s. And I will show you why next week could be the start of the default. But first, I need to know who's awake. I need to know who's watching this market break in real time and who's still paying attention to the mainstream narrative. Stop what you're doing. Pause this video. Go to the comments and tell me, where are you watching from? And did you buy the dip this week? I want to see the global army that the banks are trying to shake out. I want to know if you panicked and sold, or if you bought the crash. I want to know if you understand what's happening. Comment now. Tell me your country. Tell me if you bought. Because if you did, you're about to find out why you made the right decision. I'll wait. All right, let's talk about what happened this week. Let's reconstruct the crime scene. Monday, February 2nd, 2026, 8:45 a.m. Eastern Time. Silver spot opened at $81.67 per ounce. Silver futures on COMEX opened at $78.70, already under pressure from Friday's historic 28% single-day crash. That was Monday morning. By Friday afternoon, depending on which source you trust, silver had closed anywhere between $67.41 and $76.40 per ounce. Let me give you the different closing prints, because this is important. When a market is functioning properly, you get 1 closing price. When a market is broken, you get 5. Goldprice.org, $67.41 per ounce. Fortune at 8:15 a.m. Friday morning, $75.76. USA Gold during the Friday session, $76.40. Trading Economics CFD, $74.63. Silver futures, $73.17 after a 15.3% single session collapse on Thursday. 5 different prices, 5 different markets, all trading the same metal, or allegedly the same metal. But here's the truly terrifying number. Early Friday morning, February 6th, spot silver tumbled to as low as $64 per ounce. $64. From a January 29th record high of $121.64. That's a 47% total drawdown in 1 week. Let me put that in perspective. Silver lost half its value in 7 days. Not over months. Not during a recession. In 1 week. While demand for physical metal hit all-time highs. The Indian MCX silver contract fell from 350,000 rupees per kilogram on February 1st to 275,000 rupees on February 6th. That's a 21.43% weekly decline in the Indian market. What caused this? Was it fundamentals? Was it demand destruction? Was it economic collapse? No, it was margin hikes. On Wednesday, February 5th, the CME Group executed its 6th consecutive margin hike. The 6th, in under 2 months. They raised COMEX 5,000-ounce silver futures margins from 15% to 18%. They raised gold from 8% to 9%. Now, if you don't trade futures, let me explain what this means. When you buy a futures contract, you don't pay the full value up front. You put down a margin, a percentage of the contract's value as collateral. When the exchange raises margin requirements, you have to deposit more cash. If you can't, you get liquidated. Your position gets sold automatically. You don't get a choice. 6 margin hikes in 2 months, each one triggering a wave of forced selling, each one cascading into the next. Stop losses hitting, liquidations accelerating, prices collapsing. This wasn't natural price discovery. This was systematic destruction. Goldman Sachs noted that the volatility was driven primarily by Western trading activities, not Chinese speculation. Most of the significant moves occurred when Chinese futures markets were closed. So let me ask you a question. If this crash was driven by fundamentals, if this was real selling pressure from real market participants, why did it only happen when China was closed? Why did the paper price collapse while Shanghai was paying a 29% premium? I'll tell you why. Because the paper market in the West is broken. Because the futures exchanges are managing a physical supply crisis by forcing liquidations. Because they raised margins to make you sell. And the question is, did it work? Let's find out. Saturday, February 7th, 2026. Markets are closed. The weekend status report is in. And the physical market tells the exact opposite story from paper. Let me show you the dealer pricing snapshot as of Friday's close. The cheapest 2026 American silver eagle available across major dealers. Bullion Standard, $91.36 per ounce. That's a 17.2% premium over the $77.95 melt value. Monument Metals, $92.87. That's a 19.1% premium. Provident Metals, $93.84. That's a 20.4% premium. APMEX, $96.08. That's a 23.3% premium. JM Bullion, $100.56. That's a 29% premium. Let me read that last one again. JM Bullion is charging $100.56 per ounce for physical silver, while COMEX futures settled at $73.17. That's a $27 spread. On a $73 commodity, that's a 37% markup from paper to physical. These are not obscure dealers. These are the largest online bullion retailers in the United States. These are the companies that move millions of ounces every month. And they're charging $90 to $100 per ounce, while the paper market says silver is worth $70. Now, maybe you're thinking, well, premiums are always higher on silver eagles. They're government-minted coins. There's a collectible premium. Okay, let's talk about the cheapest physical silver you can buy. SD Bullion reported that 90% U.S. constitutional silver, pre-1965 dimes and quarters, is trading at approximately $1 under spot. Silver rounds are running $6 to $8 over spot. That's a $10 per ounce spread between the cheapest and most common physical forms. That's a 15% gap that would be unthinkable in a normal market. But it gets better, or worse, depending on your perspective. SD Bullion just released their weekly update. On January 30th, the day of the crash, SD Bullion processed the largest transaction day in company history. How big? 2.5 times larger than their prior all-time record, which was during the SVB collapse in 2023. Friday's revenue, one single day, exceeded what SD Bullion generated in some entire months during 2025. Let that sink in. The paper price crashed to the low $60s, and retail buying hit all-time highs. That's not capitulation. That's not panic selling. That's physical demand exploding while paper implodes. But here's where it gets truly alarming. The delays. New sovereign mint orders are now running 8 to 10 weeks out. That's up from 2 to 3 weeks just 30 days ago. The Perth Mint in Australia temporarily shut down new sales on key bullion lines to catch up on existing obligations. JM Bullion posted a formal operational update on January 26th warning customers of longer than normal order processing and fulfillment timelines and extended phone and email response times due to unprecedented order volume. Silver Eagle allocations are being reduced. Rumors indicate mint allocations through February are already being cut, with dealers expecting to receive only a fraction of planned supply. The U.S. Mint delayed the release of 2026 proof Silver Eagles by approximately 1 month. And when the 2026 Eagles were finally released, they sold out instantly. So let me ask you a question. Look at these premiums. 29% over spot at JM Bullion, 23% at APMEX, 8 to 10 week delivery delays, mints shutting down new sales. Do you think this is fair market value, or is this price gouging? Or, and this is the critical question, is this the real price of silver finally asserting itself? I want your opinion. Type real price or gouging in the comments. Let's debate this, because here's what I think. I think $100 per ounce isn't gouging. I think $100 is what silver actually costs when you remove the paper manipulation. I think the dealers aren't overcharging. COMEX is underpricing. And the proof is in what happened next. Let's talk about Shanghai, because this is where the entire fraud gets exposed in broad daylight. After the January 30th crash, the Shanghai silver cash price traded at a 29% premium, or $22.98 per ounce, over Western markets. But wait, it gets better. When you factor in China's 13% VAT tax required to remove silver from exchange vaults, the wholesale physical premium in Shanghai was 45.8%. That's $36.22 per ounce over Western exchanges. After shipping and insurance costs of approximately $2 per ounce, the net arbitrage opportunity to ship bulk silver to China stood at over $34 per ounce. $34 per ounce. For doing nothing except buying silver in New York and shipping it to Shanghai. That's not a spread. That's not a premium. That's a structural break. Analyst David Jensen warned, if this price disparity continues, expect drastically restricted silver availability in Western markets in the weeks ahead. Now, normally, when you see a 29% arbitrage opportunity, what happens? Traders buy the cheap stuff in New York and ship it to Shanghai. The spread compresses. The market equalizes. That's how arbitrage works. Except it's not happening. The spread isn't narrowing. It's staying wide. Why? Because there's no silver left in New York to ship. The Shanghai metals market reported on February 5th that the backwardation structure in Shanghai silver narrowed slightly during the week. But spot market availability remained tight. The deferred fee on the Shanghai Gold Exchange has consistently shown short paying long since December 25th, 2025. What does that mean? It means there are more buyers than sellers. It means physical supply is constrained. It means domestic suppliers are noticeably reluctant to sell. And here's the kicker. The Shanghai Gold Exchange just announced they're raising margin ratios and price limits for some gold and silver contracts effective from February 9th closing settlement. Think about that. COMEX is raising margins to force selling. Shanghai is raising margins to contain buying. The exchanges are moving in opposite directions. One to suppress speculation, the other to manage a physical supply crisis. The East is draining the West. China is paying the real price while COMEX plays games. And the proof is in the vaults. Let's talk about COMEX registered inventory. This is the physical silver sitting in COMEX-approved vaults that's available for delivery against futures contracts. In November 2025, registered inventory was 120.3 million ounces. In January 2026, it dropped to 109.8 million ounces. As of February 4th, 2026, it's at 103.5 million ounces. That's a 38% decline in 3 months. That's 16.8 million ounces that vanished. But here's the truly catastrophic math. March 2026 open interest, 429 million ounces. Registered inventory available, 103.5 million ounces. Do the division. That's 4.14 paper ounces for every 1 physical ounce available. Now, historically, 97% of futures contracts roll forward or cash settle. Only 3% demand physical delivery. The system works because almost nobody asks for the metal. But February 2026 delivery rates were 98%. Not 3%, 98%. Contract holders are demanding physical, and the exchange can't deliver. First notice day for March contracts is February 27th. That's 20 days from today. That's the deadline when delivery intentions are finalized. And one analyst, Bill Holter, is warning that COMEX could face a silver delivery crisis in March that triggers a financial system collapse. Now, you might think that's hyperbole. You might think that's fear-mongering. But let me show you one more number. The daily drain rate on COMEX registered inventory 785,000 ounces per day. At that rate, COMEX will have zero registered inventory in 132 days. That's mid-June 2026. But we're not waiting until June. We have March deliveries starting in 20 days. With 429 million ounces of open interest against 103.5 million ounces of inventory. The math doesn't work. Unless the vast majority of contract holders accept cash settlement or roll forward. And based on February's 98% delivery rate, they're not rolling forward anymore. Let me summarize what happened this week. The silver market didn't just correct. The silver market fractured into two completely separate markets that no longer communicate with each other. Market 1, the paper market. COMEX futures. Spot prices. Exchange-traded funds. This market says silver closed the week between $67 and $76 per ounce. This market crashed 47% from peak. This market is driven by margin hikes and forced liquidation. Market 2, the physical market. Dealers. Mints. Sovereign coins. This market says silver costs $90 to $100 per ounce. This market has 8 to 10 week delivery delays. This market processed the largest transaction day in dealer history while paper crashed. These two markets are pricing the same commodity $30 apart. That's not volatility. That's not a premium. That's a bifurcation. The paper market and the physical market have separated. And there are three structural fractures that are now undeniable. Fracture 1, paper-physical divergence. Paper prices fell 17% to 47% depending on time frame. Physical premiums expanded to 17% to 29% on Silver Eagles. The paper price and the real-world cost of acquiring silver are moving in opposite directions. Fracture 2, East-West price schism. Shanghai silver trades at a 29% premium over Western markets. That creates a $34 per ounce arbitrage vacuum that is draining London and COMEX vaults in real time. The Shanghai Gold Exchange and COMEX are raising margins simultaneously from opposite directions, one to suppress speculation, the other to manage a physical supply crisis. Fracture 3, COMEX delivery integrity under threat. Registered inventory at 103.5 million ounces and falling at 785,000 ounces per day. March open interest at 429 million ounces. February delivery rate at 98%. The math no longer works unless the vast majority of contract holders accept cash settlement or roll forward. And they're not. The market didn't just have a bad week. The pricing mechanism, the fundamental agreement between what paper says silver is worth and what it actually costs to acquire, fractured. That's the crime scene. And we're standing in it right now. So let me ask you the final question. The question that will determine whether you understand what's happening or whether you're still watching CNBC. We are 20 days away from the March delivery window. First notice day is February 27th. COMEX has 103.5 million ounces of registered inventory against 429 million ounces of open interest. The February delivery rate was 98%. My question to you is simple. Will the COMEX default in March? Yes or no? Leave your prediction below. History will judge who is right. If you think COMEX will deliver on every contract, that somehow 103.5 million ounces will satisfy 429 million ounces of claims, type "no default." If you think COMEX will force cash settlement, declare force majeure, or otherwise fail to deliver physical metal to contract holders who demand it, type default. Cast your vote, because in 20 days, we'll know who is paying attention and who is watching the paper price. And here's what I think is going to happen. I think the vast majority of contracts will roll forward or accept cash settlement, because that's what always happens. I think COMEX will survive March. But I also think the spread between paper and physical will widen. I think dealer premiums will hit 40%. I think delivery delays will stretch to 12 weeks. I think Shanghai will keep paying $34 over New York. I think registered inventory will keep draining at 785,000 ounces per day. And I think one of these months, maybe not March, maybe April, maybe May, the system breaks. Because you can't run 4.14 paper ounces for every physical ounce forever. You can't have Shanghai paying 29% over COMEX forever. You can't have dealers charging $100 while futures print $70 forever. Something has to give. And when it gives, it's going to be violent. Subscribe to this channel to watch the system break in real time, because I'm not going anywhere. Every week, I'm going to document the crime scene. Every week, I'm going to show you the vault drain, the Shanghai premium, the dealer delays, the margin hikes. Every week, I'm going to expose the fraud. This is John A.G. Liff. We don't trade the price. We trade the corruption. The paper price says silver is $70. The physical market says it's $100. And the vaults are draining at 785,000 ounces per day, while 429 million ounces of claims sit against 103.5 million ounces of inventory. The market just broke, and you watched it happen. Now you know.